Now we're going to look IAS 2 inventories. Under US GAAP, we're allowed 5 different ways of measuring inventories. The 3 major ones are LIFO, last in, first out, FIFO, which is first in, first out, average cost. We also allow standard costing and retail method in order to value inventory. Under IFRS, LIFO is not allowed. They realize that the implications for businesses to use that for tax purposes in jurisdictions like the United States allow for some differences in the numbers that appear. Under US GAAP, we use this concept called lower of cost or market in valuing inventory after we've acquired it. We take the historic cost and we compare it to 3 different values for the market cost. The first one is the replacement cost, which is how much we could get for it out on the market. Then we have net realizable value, which is essentially our selling price minus the cost to complete or the cost to sale. And we have NRV minus normal profit margin. So whatever we typically get on our sales, we're going to take that off the bottom. So these 3 values we're going to compare, and the middle value becomes the market value that we use. So in this case, if we have an inventory that's originally worth $1,000, the replacement cost is $800, net realizable value is $830, and our NRV minus normal profit is $705, we would choose $800 because it's the middle value. Comparing that to historic cost gives us the lower of cost or market, which is $800. Under IFRS, we use a method called lower of cost or NRV, so it simplifies this process greatly. Instead of comparing it against the 3 different numbers, we simply take historic cost and we compare it to net realizable value. Again, that's the selling price minus the cost to complete or the cost to sell. So in this case, $1,000 historic cost, we compare it to $830 in our net realizable value, and net realizable value is the lower of the 2. So the difference here is that we have a write-down under US GAAP of $200 and a write-down under IFRS of only $170. This would go through cost of goods sold as a debit and inventory as a credit. One other thing that IFRS allows us to do is if you look at the cost of inventory, when you take this evaluation and look at the lower of cost to NRV and it decreases the value of inventory, you're actually able to reverse that if the value of NRV goes up because of a change in the calculation or in the market price. However, you can only go up to the original cost of the inventory. You can't supersede and go to fair value in those cases. The final thing that you'll see here is that you can group similar products. So similar items can be compared together to determine the lower of cost or NRV.